What's up, guys? We're going to record a short video on candlestick structure. So as we know, when we have a low put in, we have a high put in, we put in another low, we trade up above that previous high, right? And we tap back in to continue high. Most of you guys know that as what? Market structure shift, or, quasi-modal, whatever it is you want to call it. But if something happens on one time frame, it happens on every time frame. That's the whole point of price being fractal, right? So what you see over here is you see this low get put in, right? That's our low here. And then we see the highest point was not this bullish candle. The highest point was this bearish candle, the wick that's there. So we put in that wick, and then we trade below that candle, right? Below the candle that we have here. That's equivalent to this. Sorry, that's equivalent to this. I'm putting in this high. So we trade below it, right? So what we end up getting is price trading up above it, like that. It's equivalent to this same move, trading up above it, above that high, right? So when we get up above that high, what we end up taking is the previous zone, right? That old high into the new low that was put in before we reversed to go up above the old high, before we reversed. So that high, before we reversed, right, into this low, and then when the reversal took place, we oftentimes return back to that zone to trade higher off of it. But we see this in structure as well as we see this in candlesticks. So with this is a candlestick structure flip. So what are we anticipating with this right here? We're anticipating the same thing over here for us to tap back into that zone and trade higher, right? So let's take the zone. And we want to see price drop back into here and trade higher off of it. So let's click a couple candles forward. We end up seeing price move back into the zone, right? Back into the 50% of the zone. And we anticipate a price trading higher. So what you're looking at is your entry being here and your stop being below the low. When price trades out of the zone, that's an automatic 1-to-1 for you from tapping in and trading out, right? But you can, as mentioned in previous videos that are now removed, target the high. So it depends on whatever you're risking within here, whatever point value you're looking to get out of this move. If you want to target 2R from it, you can, but oftentimes I target right out of the zone. You can target the higher, area up above there, as long as you have proper managing techniques to take you, within there before price reverses. The problem is, if you look to the left, you see that we had the same thing here, right? We had the low of this 1408 candle. We put in a high, and then we dropped below it, right? So we drop below it with this green candle. We trade up above it, and we tap back in, right? Tap right back into the 50%. And you see us trade higher, right? But that does not mean that this is a reversal. What you have to understand is that reversals happen from higher time frame zones. So this is just what facilitates the pullback and or the reversal. But this happens across all time frames. You'll see this the same way on the 5-minute. You'll see this the same way on the hourly. You'll see this the same way on the daily. You'll see this on any asset class you can find to trade. But this has to happen in a higher time frame zone in order for you to consider it a reversal. What this just facilitates is a pullback each time. So if you look right up above it, we have the same thing. We have this low, we put in this high, we put in a low right here, right? We trade up above it, and what happens? We go right below it. So anybody just trying to take a random candlestick structure flip would have been liquidated right behind that low. No chance to get out, no chance to go break even, nothing. So you want to make sure that these things are happening in the zones. How do you find these zones? Well, you were taught that in the previous video that's being released later today. So what we end up seeing with this zone here is if we click a couple more candles forward, we see price trade up out of it, right? You see another candlestick structure flip in here as well. And there you go, 1-to-1 delivered. Does it deliver the high? Deliver the high as well. But if you use this and try to say, hey, I'm going to shift to break even, set some, set my sights on the high, partial right here, set some runners, you don't know whether this is actually coming out of a higher time frame zone to the left or not. So to trade in that manner, you never prepared for this to show you whether it's a higher time frame reversal or whether it's just facilitating a lower time frame pullback. A higher time frame pullback. So you go and shift to break even, and what happens? Out at break even. Giving back all the profit you were able to make within this because you wanted more profit. So whether you were taking a 1-to-1, whether you were taking it to the high that brought the low there, you can still fumble an entry like this if you're not considerate of the fact that you need to have multi-time frame analysis or a multi-time frame approach to taking a reversal out of the area. So this is it on the 1 minute for NQ. We'll take this with us and go to YM. So same template, right? So we have this low and the high, the bullish candle put in a low and put in this high. We put in another low. We trade up above it, right? So what are we anticipating? The same thing like this schematic, right? We're looking for price to trade back in and trade out, right? So let's click it forward and see what we get. We know that this here is our zone. So we click a couple candles forward. We see it taps us right into what? The 50%. And then we see price trade out of it. So here's what you have to remember with this. With this, what you're trading is the 50% of the move, right? So there's no such thing as moving your stop to break even real fast should you see it start making its way up, because then you end up what? Getting yourself liquidated. There's a possibility that it trades back into here again and then trades out of the area, right? So that 1-to-1 is delivered, right? Well, the 1-to-1 is delivered. The high that put in that low, let's see if we actually got it. There you go, it's delivered. So for the person that wants to shift to break even and hope that we trade up here or hope that we trade to that high, that's just based on whether you're actually taking this out of a higher time frame zone. And oftentimes, if you're in a higher time frame zone, it takes 2 to 3 candles to leave that zone. So if you're in a 15-minute area, then you need to know that you're going to spend 30 to 45 minutes in that area before price leaves. So using a candlestick structure flip as an entry to take a 15-minute move, to take an hourly move, is foolish, obviously, because you could be mismanaging that entry within here before it actually trades out. Even if you were in a 15-minute move, that low could have been taken and taken you out and then actually went your way. So you need to understand that candlestick structure is relative to the time frame that you are trading it. So this is relative to what? The 1 minute time frame. What we're seeing a 1 minute candlestick structure flips. Sorry, we're not using any higher time frame to take the higher time frame candlestick structure flip, right? I'm sorry, this is the daily. This is the daily. So we're seeing a daily flip into it. So look at how long this daily flip even took, because this is a candlestick structure flip on a daily. Cool. Look at how long it took. It got here on October 7th, and it left and TP'd by October 13th. So look at how long you'd be in this entry if you're using the candlestick structure flip on a higher time frame versus a lower time frame. But it happens on every asset class. This is US 30. The last one was NQ. Now, if we go and we take the same thing over to gold, this is our template, right? We're looking for a low, a high, then we trade below that low, and then trade back up above that high, and we tap right back into the 50%, right? So if you look over here, someone eager to try and find a quick entry could have mismanaged anything on the way down here. What you have is you have the low in there, you have the high of that candlestick, we drop below it, we trade back up above it, right? And when we go to tap back in, what do you see? We run through that. So you can't use it every time you see it. It needs to be placed into a higher time frame zone for you to understand that this needs to be a higher time frame reversal if I'm taking it as a reversal. Otherwise, it's just a higher time frame pullback, right? So if you look right here, we have the same thing. We have the low that this August 6th candle put in. And when we opened up, we put in a tiny high on August 9th. Then we dropped in and put in this low. So you see we just traded up above it, right? So us trading up above that, what do you end up seeing with this when we click forward? We see price trade back into it, right? And this is where everybody's ready to hoorah, go bullish, right? That's us tapping back in. So we have that candlestick structure tap. And then what do we end up having inside of it? Since this is the daily, we have a low, we have a high, we put in another low, and then we violate the high. So we tap back in again, and you see another shift higher. You're going to see these things on every single time frame you can trade. You're going to see it above you, below you. What matters is where you are in structure. And we already taught structure as well as zones. So you need to be sure that this is your candlestick confirmation based on whatever time frame you're using to trade out of that zone. And what you often get is, yeah, we tapped to 50% and then we traded out of it, but you also got another one inside of here. And every single time you see price move higher, or every single time you see price move lower, it's always starting with what? That low, that high, we trade below it, right? We tap back into that previous range, and then you see us trade lower. Now, this right here didn't hit the 50%, but when we came back up to it over here, just about a couple months later, you see us tap into that 50% and what? Reject right out of it. So you need to be sure that you're using these things within zones in order for you to be able to profit from it. If you do not, then you're just going to chase this everywhere. You're going to see it everywhere and end up with analysis paralysis because you don't know whether you could use it or not. If you look, we have one back here on gold, right? So we have this low, we have this high, we put in a low, we trade up above the high, we come back down and we liquidate the low. So if you're just using this anywhere, that would have been your stop there, and it would have violently traded through your stop. Because using this with no context will still get you the same result you've been having. This is not the holy grail. You are the holy grail. And where you exercise your entries, where you exercise your patience, when you put everything together, that's how you end up with a high probability result. But if you're just chasing this everywhere and anywhere, this is not what you are using to say price is reversing. This is your entry confirmation in an area where you know price is reversing from, which oftentimes comes from what? A higher time frame area. So this is the daily. It would be coming from a weekly zone. If you had a weekly POI marked out, this would be the fastest way to be able to get into price and reduce your risk, and then be able to trade and achieve, whether it's that 1-to-1, whether it's the high that put in the low. There's many possibilities, but you need to be sure that you are in line with market structure, right? So let's go over to Euro USD. This is our same template we're using, right? So we have this low, we have this high, we put in another low, right? We trade up above it, and we anticipate in price tapping in and taking us higher, right? Just like all the other pairs that we use. So this is our previous range right here. And what you see is, if we click forward, price taps back into the 50%, digs deeper, trades back up above the 50%, and then takes us out. But what do you notice about within here in the 50%? What you see is, since this is the daily, you see a lower time frame flip that happens inside of that daily zone. So more than likely, this is a 4-hour flip or maybe a 15-minute flip. You're going to see it on structure on the 4-hour or structure on the 15-minute, but it's still facilitating the higher time frame flip that occurred. And this higher time frame flip would only be happening in where? Again, a weekly area. Candlestick structure flip happens in a higher time frame zone that you mark out. So you mark out that higher time frame zone and you get that candlestick structure flip. Oftentimes you're able to reduce your risk, right? That's what trading is about. Risking peanuts to eat caviar. So instead of having the larger zone as your risk and having to wait a few days within it like that, what you end up doing is being able to risk a smaller amount. So if you look here, this is about 82 pips you're risking, versus here, if you just waited for that flip that occurred within that zone, what do you end up getting? 34 pips. So you're able to reduce the amount of risk and still be able to have the same reward. Well, even more, just the same target. So this is something that's important to pay attention to, whether you're in a higher time frame or a lower time frame, that you need to be sure you're in a higher time frame zone that price is actually going to reverse from. The price is actually going to reverse from. If you look just up above us, you see right here, we have this low, we have this high, we put in this low here, we trade back up above, and what do? We go down and violate it. Why? Because oftentimes this is probably not in something back here from the higher time frame that's, sufficient enough to reverse price, right? So this doesn't change the fact that you have to follow structure going down until you get a flip. But as you're following structure on the way down, that flip needs to occur in what? A higher time frame zone. A higher time frame zone, which was discussed in the market structure and the zones video. So I want you guys to pay attention to that. And again, I said all assets, right? So let's go over to Ethereum. Now here it is. We have it on Ethereum. That's our same template, right? So what we see is this low. We see this high put in. We put in another low. This is using wicks, but this is the 1 minute time frame. So now we trade up above. We're expecting to tap back in, and we're expecting price to continue, right? So what's our previous range? What's our previous zone? The previous range is right here. So if we go forward, we see Ethereum on the 1 minute comes back, taps into the 50% of the zone, right? and then trades higher. Gives us that 1-to-1 as well as can give us a high. So you have to back test this and understand how far you can anticipate price running to in terms of your targets based on you understanding a multi-time frame approach with using this. This is going to happen on the 1 minute. This is going to happen on the 4 hour. This is going to happen on the weekly. This will even happen on the yearly. It doesn't matter what time frame you're on, but you still have to be able to place this within what? Market structure. And then your zones. Now, if it was this easy, everybody would be a millionaire. There are times where this is going to happen. You're going to think it's what you think it is, and then it's going to fail. That's where back testing comes in. If you try to trade this in a forward moving market, if you try to trade this forward testing, you're going to get cooked while learning instead of being able to trade this against previous data that's slated to happen the same way in the future. Remember, if it's an algorithm, then it does the same thing every day. So if it's doing the same thing every day, it's up to you to be able to wait and follow it until you see that moment and you can take part in that trade and exit, whether it's the 1-to-1, whether it's the previous high that brought the low. It doesn't matter what time frame you're on, but this has to be paired with other dynamics, right? It has to be paired with that, or else you're always going to end up getting liquidated chasing this little movement here without understanding that this is not a reversal. We didn't deal with whether this flip is a reversal or whether this flip is a pullback. Whether it's a reversal or whether it's a pullback depends on where it is in higher time frame structure. And that's dealt with in the market structure and zones video. So you guys seeing this across all asset classes. I hope you guys understand that, this is something that you need to back test, but this is something that you need to align with other confluences, right? Higher time frame to lower time frame. Lower time frame order flow just facilitates higher time frame structure. So this could be facilitating a higher time frame pullback into a higher time frame continuation. What you're going to do is see this same thing up here happen to the top side. Sorry, the same thing down here happen to the top side. And when it happens to the top side, that's going to take you down that way. And when it gets down here, what are you going to see? It's going to happen again down here. And what is it going to do? Take you back up there until we end up taking out a protected high. And when we take out that protected high, that's when that protected high is also going to be a structural high from a higher time frame, not this one. So when we take out that high, then we go and take out, let's say, the 15-minute protected high. Then we go and take out the 4-hour protected high. Then we go and take out the daily protected high. Then we go and take out the weekly protected high. And all of it through every time frame is going to end up looking like what? The same thing, candlestick structure. So I hope that this video was able to clear up some things for you guys. And, I hope that you guys can use this in back testing and being able to take this from back testing and be able to apply it in a forward moving market and, do what you need to do. All right. So I'll catch up with you guys later. Peace out.